Hi everybody, thank you very much to join us for, I think, one of the most interesting panels this morning. Clearly, this subject is a kind of convergence between TradFi and DeFi, and the adoption of crypto and blockchain, in particular in finance. And clearly the custody will provide the trust for the better adoption. Thank you for my dear panelists. As you see, they come from a different area. Okay.
I think it's a little hard to hear.
On different area, from pure crypto and also some TradFi experience. Could you introduce yourself, your background, your position, and your relationship with the panel thematic? Kelly, please.
Can you guys hear me okay? It's okay? I know this sounds a bit, okay. Hi everybody, I'm Kelly Pettersen. I currently lead sales at a company called Wyden. Wyden is a Swiss-based company that currently works with banks and brokers to be able to, from a software, a technology SaaS perspective, to help them operationalize their digital asset, cryptocurrency, products and services to go to market. I've been in crypto now about 7, 8 years, and before that in the traditional banking side. So looking forward to having the discussion with all these lovely men.
Thank you, Gerry. Alessandro, please.
Hi, everybody. My name is Alessandro. I'm here representing a company called Crypto Finance. We're part of the Deutsche Börse Group. I'm also heading sales, similar to what Kelly does over at Wyden. As you can tell from the name, we're very crypto-focused, and we're very finance-focused. So we are specifically a broker and a custodian, incorporated initially in 2017 in Switzerland, and licensed out of Switzerland. And then as of 2021, acquired by Deutsche Börse Group, the large infrastructure provider, and we now operate in the European Union also with our MiCA licenses out of Frankfurt. And we specifically will focus on providing liquidity in the crypto market to banks, brokers, asset managers, and other financial institutions, and also in the topic of today's presentation, custody services. More recently, as part of the broader group, we also started offering crypto sub-custody to our sister firm, Clearstream, the very large CSD. And of course, the broader group strategy revolves around custody of crypto assets, and a lot of that is achieved through the services of crypto finance. So pleasure to be here.
Thank you, Alessandro. Amarjit, please.
Hi, good morning, everybody. I'm Amarjit Singh. I'm a partner at EY. I head up digital assets for EY across EMEA. Great to be here. This is my 4th EBC, I think. We cover, as you can imagine, risk, reg, assurance, etc. in this area. To me, personally, custody is very close to my heart because I think it's a core to everything that we do. If you don't do custody correctly and you don't keep people's monies, assets safe, then you know why we're really here. So for me, really looking forward to this panel.
Thank you.
And hi everyone, I'm Gerry Afentakis of Zodia Custody. That brings me, thank you very much, quite nicely into the inception of Zodia Custody, which is owned by Standard Chartered Bank, Northern Trust, National Australia Bank, and a few other global banks. And maybe 7, 8 years ago, when the Futurism Department of Standard Chartered Bank were looking at blockchain technology, looking at how that might affect financial markets, financial market infrastructure, they realized that it was a very possible eventuality of the future, and that the key element of that would be custody, which is holding the keys to those assets safe. And they looked around in the market to invest in a digital asset custodian to deliver to them the level of service that a tier 1 global bank expects from their service provider, and they couldn't find one, and that was the kind of the incepting philosophy of Zodia. So we are a pure play digital asset custodian, which means all we do, we never touch TradFi assets. We only touch digital assets. We don't do brokerage, which is slightly different from Alessandro's firm at Crypto Finance. We just hold assets safe, and we do that relatively globally from the UK, Mika here in Europe, UAE, Australia, Hong Kong, and Singapore.
One thing we forgot to say is what the relationship is. So we're somewhat competitors, we're somewhat partners, but we're also all somewhat friends.
Great, great. It's the concept of cooptation, you know. It's in one way a competition, another way a cooperation. Great. And myself, Xavier Gomez, I'm a group chief operating officer of VANCELIAN. VANCELIAN is a French fintech, provide wealth management for ultra net worth in Europe and in EU, Dubai and Abu Dhabi. And in fact, we provide crypto trading, tokenization of assets, RWA, and also, what did you say, some financing. So thank you for your introduction. Let's start. We will try to explore the evolving of landscape of asset custody and on different angle, trust, regulatory, and also technology, security, and the market dynamic. Can each panelist briefly define what custody means in their perspective domain? Which one want to start?
Should I kick it off?
Yeah.
I think the evolution or the definition of custody has definitely evolved over time. I think custody, if you had asked me this question a couple years ago, would have been very much focused on just keeping private keys secure, keeping assets safe, because at the end of the day, that is the one element that blockchain effectively introduces that wasn't really common in a TradFi. You know, you can lose a stock, you can easily retrace it. Blockchain finality and transactions that go from one wallet to the other might be much harder to actually get a hold of if the beneficiary wallet wasn't the right one. So I think it was in the past just asset safekeeping. Today it's increasingly so, especially in our institutional space. I think abstracting away a lot of the complexity of managing keys. This is especially something that Gerry's company and mine do quite a bit. It's effectively enabling access to an asset class without forcing the value chain downstream to have to deal with operations and complexity that at the end of the day doesn't really contribute to their top line and their profitability.
I was just gonna add to that. From a Wyden perspective, we're not a custodian. We're a technology company that works very closely with custodians, so we're custody agnostic when it comes to Web3 crypto native custody. And the two when we speak with banks around the world and we speak with brokers, we're seeing the way that they're thinking about digital asset or crypto native custody really in two ways. One way is around this sub-custody model with Alessandro, which Alessandro mentioned earlier, which basically means you're sub-custodying out that risk basically to a regulated or qualified custodian. There's a lot of benefits with that when you think about using a qualified custodian, because they are basically managing the assets one-to-one, they have a fiduciary responsibility, they have the dependency operationally for you to lean on them, and basically you're leaning on their custody operations and their custody responsibility and trust factor there. The other side that we're seeing a lot, which is very, very competitive to that sub-custody play, and you're seeing different regulated custodians move into this more technology core platform offering, is around custody tech. So these companies may, if it's a technology platform, they will not typically have a trust company or some sort of licensing that allows them to have that fiduciary responsibility. But what these companies are doing is they're allowing you to take on that custody risk in crypto. So you're taking on acting actually as the fiduciary, as the qualified custodian, which might mean you need to get extra licensing there, and there's a dependency on the key management side for that company, be it a Fireblocks or a crypto finance that has a technology platform, not their regulated platform, or Zodia, I know, is also looking into that or has maybe launched that, a technology side. So these are the two different ways, and I think it's less about which one's right or wrong. I think it's more about your custody philosophy as an organization.
Gerry, I'm interested by your definition, because you are a member of the big group, a traditional group, Standard and Chartered, with the spin-off Zodia.
Sure. So maybe I'll answer the question by continuing the story. The philosophy was to create this digital asset custodian that would represent everything that a service provider to TradFi financial institutions would do. And so Zodia was constructed in this very regulatory compliance, risk management, prioritized way. And we entered the market in 2019, 2020, thinking that this bank-owned, bank-grade custody solution would result in stampedes of clients knocking down the door, and what happened? Nothing happened at all. Nobody was interested. And so to answer your question, Xavier, what a custodian is fundamentally an entity that gives its clients confidence that their assets, the keys, the ownership rights to their assets are held safely. But unlike with gold, where you can stick it in a vault and surround it with the threat of violence and people typically won't come, with digital assets, people who hold these assets want to do things with them. And that's the part that we had originally miscalculated, and that's what I guess a digital asset custodian today needs to be, which is why Crypto Finance are a very successful firm. They combine the custody element with the brokerage element, and they appeal to a certain client base, and they do that amongst the best in Europe. Zodia has taken a slightly different approach. We don't have an integrated execution, brokerage, trading element. We looked at the market and realized, rather than trying to be the best at more than one thing, let's become just the best at custody, and let's integrate across the spectrum of what people want to do in digital assets with best-in-class service providers from all the other parts of the business. So execution, staking, other treasury management tools, quantitative trading and facing exchanges. So the way that we envision what a gold standard custodian should do is just keep assets safe in the best possible way, but at the same time offer clients the ability to frictionlessly consume any kind of service that they want to consume within the digital asset ecosystem. Voilà.
And I think to add to that, I think a couple of points occurred to me. The first point is I actually think that the difference between TradFi and digital assets custody is going to start to disappear. And I say that because of tokenization and the way real-world assets are becoming tokenized. To me, I think in about 5 years' time, we will not be talking about crypto custody, digital asset custody, and traditional custody, because I actually think it'll be one. Because you don't want to have, be it an institution or retail player, separate pots to put stuff in. Right? And I use the word stuff in a very loose sense. You want to be able to put what you have in a safe place. You want to know that it is safe so that you don't have to go digging in a dumpster when you forget your keys or when you accidentally throw a hard drive away, right? You want to have it in a safe place so that somebody else is taking care of it. You know that they have a fiduciary duty to you. You know that they are regulated to make sure that it is there, and if it's not there, you have a claim. And you can then use that wallet to do anything that you want to do. That, to me, is actually the environment that we should be thinking about and we should be going towards. But obviously, it'll take us time to get there, because for the reasons that Gerry really well articulated as well, I remember doing custody audits when it was gold. I used to go down to the vault at HSBC and actually count the gold bars that were owned by the gold fund, right? I remember doing that, and it's the same vault that he used for Goldfinger, right? And now it's a hotel, by the way. It's not there anymore. It's a hotel. You can go to the bar, but. The concept of custody then, which was the key to the vault, is still the same concept we have right now, right? Those days, you just worried about somebody stealing that physical key. Now you worry about somebody stealing that electronic key. And just like in those days, somebody, as you said, Gerry, you had your threat of physical intimidation or whatever so that people didn't steal that key. Now we try to do different things with the virtual key to try to stop people from effectively still getting to those assets. But to me, what I think we should always remember is the core risks that we are trying to actually achieve and the core benefits that we are trying to achieve is actually the same. To me, it's how do those actually now manifest, and they might manifest in a different way, and we need to be cognizant about that, about how we bring that as a service to the industry.
But Amarjit, your point is very interesting, because I think it's a challenge to manage the keys for customer and for corporate. This is not the same organization, not the same challenge. Today, most of you, if I'm not wrong, you address to corporate, B2B. And do you see a potential revenue model stream to address directly to B2C?
We can't. We're an institution-only facing business. There are intermediaries, and ultimately what we do is similar again to Alessandro at Crypto Finance. It's a B2B2C. So we face the institutions that have a client base. To Jeet's point about digital asset custody and TradFi custody kind of merging into one, I think fundamentally, when we talk about crypto, it's not just Bitcoin, Ethereum, and all the other tokens. It's real-world assets that are tokenized. We have a client, they've tokenized uranium. What does that mean? That means that they've created a digital asset that is representative of stock, of physical uranium that's held in a warehouse. Turns out that this is probably the best and the most frictionless way for any investor to access the asset class of uranium, right? So fundamentally what happens in the future is that platforms like Robinhood, Revolut, N26, whoever it might be, they think, you know what, we have a demand from our retail investors, the guys that people like Zodia and Crypto Finance service, to consume or take a position in a particular asset class. For now, let's call it uranium. And there are a number of products. You can have an ETF, you can somehow manage futures, or you can buy this tokenized asset. And fundamentally, the retail user at the other end of that transaction doesn't care about what the asset is or how it's held. All they care about is getting exposure to what they want to get exposure to. So ultimately, what you'll end up seeing is this kind of merging of TradFi and DeFi and all these terms that we talk about and differentiators today. Ultimately, it's just finance, right? Somebody wants to consume a certain asset, and however that asset is constructed is completely irrelevant to him. And if it's created on the blockchain, then the TradFi institutions will have to partner with a digital asset native custodian who can, do 24/7 settlement, be, constantly operationally active.
If I may add, so I think it also comes down to picking the battles. So yes, we're all representative of B2B, and I think part of it is because we kind of started there, and addressing the consumer at the end is a very different type of business, but also because we probably all believe that there's going to be the market is going to evolve where the consumer today, and I'm talking about the natural person like the Alessandro, the Kelly that's walking down the street, will ultimately get exposure to these assets differently from what they have the past 10 years. We work a lot with banks. Now, I could go to the banking clients and try to get the next 10 million retail customers in Spain, or I can just go to a bank, enable them to offer the service to those 10 million clients they already have. The acquisition cost, it's night and day, right? So I think more and more the value chain is going to develop. A lot of these traditional financial rails represented by the banks, asset managers, product issuers, so on and so forth, will effectively simply add to their portfolios or their service offering these new asset classes, these new blockchain-based products, not just crypto products. And all of a sudden, if you are ultimately servicing those institutions, you're able to capture the flow on one hand and the AUM or the AUC on the other anyways. And this is also true of crypto exchanges, by the way. And I think increasingly so, you see more and more crypto exchanges launch institutional versions of their offerings because they know that they will be losing some of the retail customers, but they still want to capitalize the flow amid with a slightly smaller margin upstream.
I think from Wyden's perspective, I mean, where I mentioned before, we're a technology layer for basically brokerage, crypto trading, crypto brokerage use cases. We work with banks and brokers directly, and there's different use cases that those banks and brokers deploy when it comes to crypto brokerage. We see both retail use cases and we see institutional use cases, and I think for both of the use cases, our technology applies, but there's a lot of different considerations that each of those banks going to market need to consider. So on the institutional side, you see a lot of banks now doing more prop trading kind of capabilities, for example, or they might be taking on more orders of magnitude from their clients, looking at RFQ orders. How do they structure their custodial setup, right? Is that risk kind of brought in-house through maybe a Fireblocks technology platform or a Zodia, for example? How do they actually do that downstream reporting? If there's tokenized products, does that actually come into play in terms of how you think about that kind of programmatic layer of technology? On the retail side as well, the orders are much smaller in magnitude, right? They're much smaller clips. So how do you actually service that? How do they manage that risk associated with that? How do you report back to those individual consumers? And how do you set up custody models, be it, say, an omnibus structure versus like a segregated client account structure for maybe an individual versus maybe an institution? So there are a lot of different considerations that play, I think, in terms of when you're servicing an institution and a retail client. And I think the market is converging more and more, and I think the technology, like these guys said, exchanges started off in retail, they're moving into institutional use cases. A lot of us started off in institutions. We're also trying to adapt to ensure that we can kind of manage that convergence. So I think a lot of this, to Jeet's point, is really coming to a head, and I think custodians more and more are going to be looked at more as less of just a kind of manual custodial gatekeeper in a way. I think they're going to be looking to become more and more as almost an end-to-end operator in terms of a trade life cycle. And you can almost think of them, if you move further down into tokenized products, into programmable money, you can really think about them almost as some sort of programmatic validator in terms of how they start to operate. So I think that's going to come, but we can talk more about that, and I'm sure you have some questions around DeFi and what all that looks like, but those are some of my thoughts.
Thank you. From regulation, what are the regulatory expectations for custodian in TradFi and crypto, and what is the impact on innovation? Because regulation usually, in particular in blockchain and crypto, is very criticized in Europe and the US. What is your position on that?
I'm happy to start on that one if it's useful. I think what is, when it comes to custody, especially when you're talking about the institutional space, lots of institutions want regulation to give them the comfort that they have, or that they need, sorry. But as you said, that comes with the innovation challenge, and how do you balance that? I think what I have seen, and definitely seen across many different jurisdictions, if I think about Hong Kong, if I think about Singapore, if I think about MiCA in the EU, if I think about Abu Dhabi and Dubai in the Middle East as well, and then more recently in the UK and the US, I think what we're actually seeing most firms do is what we've already touched on in this panel, which is actually take best practice that already existed in the TradFi space and then mapped it across, right? Mapped it across with some sensible principles and sort of said, look, we know this is what we need to do in the TradFi space to give comfort to our users, to our customers. Let's think about how we map that across. And in most cases, actually, the regulations have not been stopping them from doing so. So, for example, I think when this first came out, we had some regulators hard coding hot and cold wallet percentages, if people remember. A lot of that have now been like, they've changed the rules, they've softened it, they've said, look at how you set up yourselves, look at your risk framework. So I think regulators are also on the journey with us on this. But I actually think that if you read across the principles, we're actually seeing most firms get to the right answer. The challenge I think that we are going to have, though, is on DeFi. Because I think DeFi changes the game a little bit more. And what do I mean by that? I think, in the current setups, it's still quite easy to know who owns the asset, who owns the digital asset, where it is at a point in time. But when you start to get into, maybe not simple staking, but more complex DeFi scenarios and situations, it is getting far more difficult, or at least we struggle, and a lot of other firms struggle, to know where is the asset, who owns it at a point in time, what happens if any of those firms go bust during the merry-go-round, right? We're on a merry-go-round, it's moving. While it's moving, it's all fine. But if somebody hits the stop button, right, do you know, are you clear about what your asset is? Do you know who owns it? Do you know what rights you have over it? And do you know how can you get it back if you need to? Or is it lost? I think that, though, we have a lot of work still to do.
Maybe just to add and double down on what was said. So a lot for certain features or for certain jurisdictions, there's actually not much new which regulation has addressed. For example, in Switzerland, with the DLT Act of 2021, if you were a securities firm or a bank, all of a sudden you could offer crypto services, trading, custody, etc., without doing that much additional work, right? So nothing too new. Having said this, there are certain service lines, especially in the post-trade side, staking to name one of them, which were not regulated. So all of a sudden, the guidelines and the caution level, or the guidelines were absent in the beginning. You know, this was 21 and 23. There was a circular in December that was published, so it became a lot clearer. MiCA is instead a little bit farther behind on the staking side, which is regulated under the custody front, kind of. But there was a degree of comfort. Now, that comfort, though, wasn't extended to everything. As a custodian, oftentimes, we also treat crypto assets are all the same, or blockchain-based assets are all the same, because technically, they actually are. If I have a tokenized money market fund, or a tokenized product natively on chain, or some sort of token standard that is regulated on MiCA, it's actually the same kind of private keys, the same kind of HSM, MPC setup behind the scenes, right? But all of a sudden, if I'm in Europe, or not only in Europe, but I've got MiCA on one hand, I've got MiFID on the other hand, right? So it becomes, the barrier to entry now especially has increased quite a bit. Now, we've been around a long time. Zodia has been around a long time. Our parent companies have been around longer than all of us have been on this earth, right? So that definitely does come with some advantages, but it does stifle, to come to your question as well, innovation, I think, when it comes to the slightly smaller players. A lot of what we're trying to do is kind of now squeeze a lot of these asset classes into traditional rails as well. I think some of those rails will evolve, but it hasn't really been the case too much today. As an example, and then I'll end my thought, open loops, whenever you need to transfer money from left to right, crypto assets from left to right, generally, especially if there's a CASP or CASPs involved, requires travel rule information to be exchanged. Now, in TradFi, it's relatively straightforward. Swift is an option of doing so, but guess what? If you have assets at Zodia or at Crypto Finance, and you've got an end customer which wants to move them out, generally they're not going to move them to a MetaMask wallet on their phone. They're going to move them to a crypto exchange for whatever reason. Now, how many crypto exchanges are on the Swift network? Not too many, right? So even though regulation has come in and has provided additional guidelines, sometimes it still lacks a degree of standardization in how things are done. Which now many different players in the market are obviously working on, but there's still some question marks left.
I'm going to maybe answer that question in a more basic way that is more aligned with my primitive Greek roots. The essence of any market is liquidity. It's very simple. You can have the best asset class in the world. If there's no liquidity, everyone goes home. So regulation is ultimately an unlock to liquidity. The largest holders of liquidity in the world are institutions. Institutions have much more to lose than to gain by entering crypto. Therefore, they won't take the risk unless there's regulation, there's a rule book, there's a playing field, there's rules to the game to enter that market. So from that perspective, regulation, phenomenal. Then, how does that trickle down to innovation? Quite simple. Today, we're seeing global TradFi institutions issue fixed income securities on-chain, settle trades on-chain. You have NASDAQ applied to the SEC to be able to issue every single company on the NASDAQ in tokenized form. That's irrevocable proof to the crypto native community, those guys who have been in existence since 15 years, that this crazy thing that they've been building on the sidelines of the world and they've been ridiculed for 15 years is actually working. And the mainstream financial system is adopting the things that these people have created behind the curtain, so to speak, or at least the curtain of traditional finance. So what does that do? That irrevocable proof gives them an enormous amount of confidence and, what's the right word? excitement to continue to build. So are we going to see, under the rules of MiCA, which is the European regulatory framework, massive innovation? Probably not. But we're going to see that innovation in other pockets in the world. And like with everything, the big institutions will cherry pick the best solutions, the best services, the best of everything. They will urge their regulators to incorporate the ability for them to be able to consume and to perform those services within a regulatory compliant framework, and then regulation will keep up. So ultimately, I think it's just it's a symbiotic relationship and a very pleasing development of the market to watch from our side.
Thank you. From risk and resilience perspective, what are the biggest risks facing custodian today, from point of view?
So I think custody and an institutional grade custody has been around now long enough where operationally things are pretty smooth. They've been ironed out pretty well. Now we can talk about quantum computing, but it's not like technology to defend yourself from it, blockchain protocols, et cetera, will stop evolving. Like technology will evolve, and it can assure you, we're talking about a 4 trillion asset class. If quantum computing is really that big, I'm sure everything else will get impacted before crypto gets impacted. There's not that much money in crypto compared to TradFi. But that aside, if I may, probably one of the things that are keeping up a lot of the CFOs and CEOs in the custody space today are not so much on the security side, which of course is always important, but it's also on making sure that the service lines don't get commoditized too quickly. And custody is a heavily commoditized ecosystem in the traditional sense, and it's also increasingly so in the crypto space. And not to hijack the conversation, but of course with the approval of a lot of the ETFs in 2024 in the beginning of the year, all of a sudden the margins went down to nothing, right? So you start seeing crypto products which are on the market at 18, 21 basis points, maybe even a little bit less. And so all of a sudden, the custodian behind the scenes need to continue making money to keep on investing, keep on innovating, keep on providing those ancillary services, and obviously without moving away from security, but at the same time, they still need to get the assets to come in, and they still need to make the money to keep on investing into the future. So I think that is one of the things that is actually very relevant today, and that is why, growing past just being a pure custodian to being interconnected with other custodians, other liquidity providers, middle layers like the ones that Wyden provides, all of a sudden make the news a lot more than just providing secure custody for a new asset, or potentially developing an MPC algorithm that's a little bit more refined, or getting an additional certification, FIPS, whatever it might be called, on the HSM front.
I'm going to answer it again more basic. You always give the better answer. I'll give the more simple one. Security, obviously, we all know that. Fundamentally, we're in a new asset class, which is highly volatile, with infrastructure that hasn't stood decades of testing. So, like we saw, when was it, a week ago with the massive liquidation event, one of the biggest concerns for all of the service providers in the industry is just that the platform is robust enough to handle these massive volatility events. And people might say, well, that's a ridiculous idea, but Binance went down. For a custodian, especially like ours, which is traditional financial institution facing, reputationally, if your platform goes down in a stress scenario, it's pretty certain that your clients are going to leave pretty fast. So optimization and operational resilience of the platform is, I think, something that isn't really spoken about so much, but it's relatively key.
And I would completely agree. I think we haven't yet woken up to the fact that this is these events remind us that it's a 24/7, 365 world we live in. We don't have weekends to clean things up. We don't have an hour at midnight to switch things off.
And volatility events always happen on Friday night.
Absolutely. It always happens on Christmas time or New Year's or weekends or everything else, right?
When Trump is awake.
Pardon?
When Trump is awake.
I can't possibly comment. But, the point for me, though, is that uplift, I completely agree with you. I think the industry realizes, but I don't know whether they actually properly have got the memo. And I'd love to hear, Kelly, from your perspective, given you work with a lot of different brokers and crypto custodians, how do you guys think about this?
I think for a lot of the large institutions that want to get up and running in crypto, it's actually, they come to us, they choose to work with us to run their operations for crypto brokerage, and then halfway through that delivery time period and that implementation time scale, they come to us and they think, what if we want to do this 24/7? We don't have an operational team that actually handles that over the weekends. How do we think about that? Can we outsource that to you? You know, what do we do? And so a lot of the times the way that they'll start off is in an incremental phased approach, whereby they'll run in line with their traditional operations Monday through Friday, and they'll run what we call a closed loop system. So they actually very much manage the end-to-end offering, be it crypto trading or some sort of retail brokerage solution, Monday to Friday, say 9 to 4, 9 to 3, 9 to 5, depending on the time zone, and they'll allow their customers to interact only inside their own architecture and infrastructure. They don't allow transfer-ins from other exchanges, they don't allow transfer-outs. That way they don't get involved in travel rule, for example, that Alessandro mentioned, which can add another layer of complexity around data sharing. And they start slow and they start incrementally, and that's what we advise. They take a phased one approach to market, maybe by launching just spot crypto trading, one custodian, a very simple model with the custodian. Maybe they don't even automate that inside Wyden on day one. Maybe they do that manually outside of Wyden. They launch, they get a feel internally with their custody team and their operations team and their risk team and their compliance team, their C-suite get comfortable. And over time, they say, actually, we're more comfortable, we understand our target operating model, the business case has proved out. Maybe we're not maybe we're not profitable yet, but the revenue is starting to come in, and as a result of that, we're going to start looking at how we operationalize this further, how we automate so we decrease operational risk. What does that mean? That could mean adding on another custodian, setting up additional sub-accounts or segregated client accounts. That could mean actually automating their settlement lifecycle. So inside the Wyden platform, for example, you can actually automate end-to-end how you think about settlement. So if you may have pre-funding with these counterparties, which is another kind of challenge and constraint in crypto, because a lot of us are used to more of like these prime broker or credit intermediary models. So they may have pre-funding, or they may work now with some of these credit providers that allow them to have more flexibility with trading, but they can actually automate that through Wyden, so that takes a lot of the operational risk and manual risk out of the equation. So we see a lot of that. And the last thing I just wanted to mention was, outside of kind of the centralized custodial model, or maybe the more monolithic or centralized approach, if you were to really go out on the scale and think more about the decentralized model and working with when custody maybe moves more into a programmatic fashion and you bring in actually smart contracts into play, which I think is much further down the road, there's a lot of other risks. So you might be able to automate payouts or transfer of assets, or different ways to potentially stake based on conditional parameters inside a smart contract, which could be really, really interesting because it opens up a much more end-to-end ownership for a custodian. But at the same time, those centralized risks that you might get with a QC, a qualified custodian, don't come into play as much as these decentralized risks. So for example, you might have smart contract risk, or you might have risk of who that centralized entity is. If that entity falls flat or there's a hack, where do you go? The regulatory arbitrage is there as well. You don't have one regulator or multiple regulators regulating these companies. Who's actually regulating this smart contract or DeFi platform that you're working on, right? You have Oracle risk, right? In terms of the risk around the Oracle and how actually the data is coming in. And if somebody is able to kind of take over more governance inside these DAOs, inside these decentralized autonomous organizations, they can actually have access to maybe some sort of hacking capabilities or getting access to the Oracle in some way. So there's a lot of these other risks if we actually kind of play around and go a little further out on the risk spectrum, moving from kind of a centralized model to a more maybe decentralized or less monolithic approach as well.
scaring us a little bit.
I think it's fun to kind of think, because we keep moving in a more innovative direction, and if we think more around, you know, where the market eventually could be going, you could see this converging with TradFi really well from a tokenized or programmable money perspective, and they can set up their own you know, their own, you know, I'm not going to debate private versus public permission blockchains, but they could set up their own permission ways of working and have programmable, you know, tokenized assets and use these smart contracts actually to become, you know, not just the custodial level, but much more around the NTN life cycle of a trade. So I think it all does converge, even though I'm talking more about DeFi, it all comes together.
If we discuss the future outlook of the custody industry, do you see a convergence between TradFi and crypto custody models?
I think there will be a degree of convergence for sure. I think there's going to be a lot more coexistence. Now, at a group level, for example, because we also have a CSD with 20 trillion in assets under custody, we believe that centralizing also crypto assets and down the road tokenized products is actually a great way to ensure safety. AKA, if I can move assets from one place to the other without them actually leaving the wallet that they're in, it's going to be significantly, or it's going to reduce the attack vectors compared to moving the assets from one custodian to another custodian to another custodian. Of course, I'm talking about a CSD which has a lot of those assets today. In the crypto space, a lot of those assets will be with a CSD. A lot of them will be with a crypto native custodian with the backing of TradFi. Some of them will be with individual banks that have been providing custodial offerings in TradFi, which have decided to in-source wallet infrastructures. That's why I talk about coexistence.
But I put this question because you heard the comment of Security Exchange chairman in US about to make the US financial market on-chain. For me, it's changed the game, also for custody. If they accelerate in terms of regulation on that, before the end of the mandate of administration Trump, it should be a big jump.
I think it's a big destination to get to, but the transition is ultimately going to be very gradual. But I leave the word to.
Yeah, I think. So Zodia is a really good example of this because we're owned by a bunch of banks, and one of them, Standard Chartered Bank, who's our largest shareholder, also has their own custody offering for digital assets. So people ask themselves, well, how can these two things coexist? And the truth is that, you know, as we touched upon before, Xavier, like, there's a speed of innovation, there's a speed of product development, there's a speed of new functionality within the digital asset space that a traditional financial institution who has massive distribution capability that we could never match, but cannot keep up with that speed. And so fundamentally, I think Alessandro is 100% right, is that you'll end up with a future where you have, you know, big TradFi firms with immense distribution. You have more embedded digital asset native firms who are more close to the evolution and the innovation of what's happening in the market. In many cases, sharing clients. You know, so the same client will have an account with the big firm and also have an account with the digital native firm because they're able to do different things. And it'll be a kind of, again, to use the word the second time today, a symbiotic relationship which is complementary rather than what I think most people think, which is trying to figure out how in a zero-sum game one side will win and one side will lose.
Well, I think I agree with all of what's been said, and you don't move trillions overnight, right? Daily, trillions don't move overnight to new chains or new infrastructure unless there's a good reason to do so. I think we need to have better pull. Right, we need to have that new infrastructure showing the benefits better to pull that, and smart contracts and making things easier, reducing risk-weighted assets, reducing settlement risk, reducing credit risk are all good reasons for all of that to happen. And I'd say that we still need the rest of the ecosystem to also follow. So, for example, you know, I chair the Digital Asset Steerco at the Chartered Accountants Institute. We need to get the ICAW. We need to get the accounting right. We need to get the tax right. We need to get the prudential regulatory treatment right. We need to get all of this right, because without all of that in place, the institutions aren't going to really come either. They're going to dabble, but they're never going to come across unless they're sure that actually by them treating these assets in the same way, they're going to end up with all of the same treatment. And this was touched on in the previous panel as well. You know, you need to have all of these hygiene factors, right? You know, we know how FATCA works in the TradFi world. But as you pointed out, Alessandro, you know, travel rules still need some working in the digital asset world, right? We need to have all of this in place as well if we're looking for that flood to happen.
I think it's time out. Thank you very much for your tips and your highlights on this key subject for the development of blockchain and crypto industry. Thank you very much. Let's applause to my co-panelists.
Thank you very
please.
much.